Well, good evening, everybody. Blair Nightingale here. It's time for Market Monday. We're back at you. Our new series, Navigating a Bear Market. Remember, the indexes are down. The S&P 500 specifically down more than 20% from the high, kind of fluctuating and vacillating a little bit right at that level, but has been and no doubt will be below that level again. Okay, so we are officially in a bear market. If you didn't see last episode we had the July 4th holiday last week, but the last episode we did, which we do every Monday right here on YouTube and Facebook, we're streaming to our friends on Facebook Live as well as YouTube. Remember, you can always subscribe, whether you're on Facebook, you're on YouTube. You can like us on Facebook. You can subscribe on YouTube. You won't miss anything. We're here every Monday night at 6, and we've started a series on navigating a bear market around our community here at Tradeway, talking to training stock traders, options traders. We talk a lot about these bear markets and bear markets being times of great volatility. Now, in some ways, I suppose in a large way, a bear market is a time of great negativity, right? By and large, the news is negative, the tone is negative, the feeling is negative. And when you look at stocks going up versus going down versus going up, negative on the downside, you're getting a lot of big down days, right? So all that to say, it can be very negative. Why do I say all that? Well, because for us, that doesn't necessarily have to be the case, right? The news is negative, okay? Maybe the jobs data, the economic data as a whole, right, is negative, right? Inflation's going up, that's negative, right? There's 2 job openings for every 1 worker looking for a job in America right now, right? That's negative because the economy is so hot. Right, I could go down the line there. We've got shipping delays and so on, fuel prices. It's negative, but that doesn't necessarily mean that for you and I as traders, they're all bad things. They're not. They're not bad things. Because one of the things we come to understand as traders, not just long-term buy and hold investors, right? I taught our Step 1 course this past weekend, and one of the primary principles, foundational lessons we learn in that course is that we don't have to be at the mercy of Wall Street telling us that the only thing we can do is buy and hold, right? If you're joining us tonight or you're watching this by recording, if you are buying and holding, right, only, and you have believed that the only thing that you could do with your money in the stock market is buy and hold. Now, I know this is becoming less so the case because the message is getting out there. But if that's all it is, well, then there's probably a lot of fear and anxiety around your investments right now. The reason is because if you're just buying and holding, right, that's not how we navigate a bear market. Because if you're just buying and holding, you are losing a tremendous amount of whatever exposure you have to the stock market, most likely, okay? If you're not seeing a significant drop with what's happening, it's probably because, which on one hand is good, right? That's a good thing, but it's probably in many cases happening because there's so heavy of diversification that you're missing out on tremendous gains when the market isn't moving down, right? Now, there are different investment objectives for every person, every age group. It's not my goal to make a sweeping statement on what you should be doing in your investment portfolio, because that's something we do individually with people. But as a whole, okay, we do not have to be buying and holding only. We actually embrace the bear market because, number one, we have skill sets that help us navigate what is happening. I'm going to expose you to more of that tonight. We have skill sets, so we know when should I be getting out of this market, right? We're going to talk next week about when should I be getting back into this market, right? I don't think we're there yet. And that's what we're going to talk about tonight. But I have skill sets that empower me to know more about what is going on and what should I be doing. And by the way, I'll give you a hint. Stock trading and these skill sets are never about knowing the future. We never know the future in the stock market, and we don't need to as stock traders, okay? So that's really, really important to do. Number two, and we've talked about this as well, we also know that volatility and uncertainty, right? Downward movements create volatility, and that creates opportunity. There is opportunity, okay, in these volatile environments, especially, I would say, especially for options traders, people who understand how to use options. There can be tremendous opportunities for trading. Certainly, this is not a time where we are forced to sit on the sidelines and do nothing. And there are instruments we talked about last episode that you can look at using to actually protect your money. So that's my 1-2 point there, right? This is a time where we can protect, and this is a time where we could look to even promote, okay? Instead of it just being a time where we are powerless, we sit back and hope that the market stops falling. Because one of the things we're going to talk about today is how low can the market go? You can see in the box here on the screen, I've got the S&P 500, and it's come down quite a bit, but we have not bottomed yet, okay? We are still in a bear market, and this is something that we need to look at because as it bounces, right? We've had some recovery. Oil and gas, I mentioned in the open here, it's actually come down a bit, right? Our gas prices are starting to come down a little bit at the pump. I think it was yesterday, maybe it was the day before, it was Saturday. I saw that it had come down the biggest drop we've seen in 2 years. Okay. Now, oil and gas had run up really hot. Okay. So you would expect to see bigger drops, which actually is what we're seeing in the overall market. We've seen tremendous inflated prices in the market, and that has created a drop. Now, what's interesting, and we're going to look at, is that when the market drops, it's natural for traders and investors to start to think, okay, it's dropping. Now maybe I should be buying, right? But we have to look at, are we still in bear market conditions, and do we need to protect ourselves? We have to look at how inflated were these prices in the markets really? Because if I don't understand how inflated they were, then I may misjudge how far they are likely to fall, okay? We're going to look at that. I've had several people in my life asking me, reaching out and saying, Blair, I believe the market's on discount, right? Should I be buying stocks? And while I do agree, generally speaking, the longer the market falls, right, the less risk one can be taking if they are choosing to get back into the market. And I'm speaking broadly of the indexes here, more of the index ETFs, right, like the SPY, SPY, Qs, right, things like that. But that doesn't take the reality out that I just mentioned, that because equity prices, right, the indexes were so high based on stimulus. If you remember what I said last time we spoke, I've been looking at retail and just how retail's been getting killed. There's a lot of retail companies out there that were planning to file either for bankruptcy or bankruptcy protection in 2020, right? February of 2020. COVID hits, the market tanks, tons of government stimulus, and it actually bailed out a lot of these retail companies from having to go down that bankruptcy road. So money just got pumped in. Guess what? A lot of those companies back in that same place they were at when they started. Now, I said that last time. I highlight that tonight to say that that price inflation in the market is pretty considerable. And I remind you of that because if we're saying, well, how low can this thing go? That's something we need to keep in mind because it can potentially go lower than we think. But we don't just need to think about it. Let's go ahead and take a look at the chart. Benjamin is options. I'm reading your comment here, Ben. Options made it to the live. Joshua, we had a dot-com bubble in 2000. Here's a comment. I'll just go throw it up here. A housing bubble in 2008. Do we have a valuation bubble in 2022? I don't think there's any question that we have a valuation bubble. Of course, and I know you're getting at this too, how big of a bubble, right? How big of a bubble? And that's the question. We've got earnings coming up this week. I think earnings is always important. I noted in some communication to students this morning that I think this earnings report, this is going to be a bigger news item, right? One of the things we do at Tradeway is try to help our students how to sift through the news so that you don't just feel like you're swamped by all the financial news that's out there. Earnings, for those that don't know, companies have to report earnings. If it's a publicly traded company, they have to publicly report earnings once per quarter, 4 times a year, of course, right? And so we're coming up into earnings season where a lot of companies in the markets are going to be reporting. And I think it's going to be a time that's telling because we want to see these companies lay their cards on the table and reveal just how bad some things may have hit them. I'm going to talk about that a little bit more as we go on because there's a lot of factors coming into play here that I think are still giving us a lot of negativity. So when I go to Josh's question about what's the valuation bubble or how far have we gone, have we maybe popped that bubble already? And I think there's some more pieces of information to come into play here before we actually are able to make that assessment, which for you and me means it's not a bad idea to have patience with this market. So let me go ahead. I'm going to change this a little bit here. Let's pull this up like so. I want to make sure you guys can, actually, let's do this here. Make sure you guys can hear me. I'm going to go to a 3-year view of the chart. Okay. So we can get a view of pre-COVID highs, right? And then obviously the COVID lows. Okay. Now I will say, when we look at this, what are some of the key technical levels? And I also wanted to say, what are some of the experts saying? And I don't do the air quotes out of, disrespect, but it's important for you and I to understand. We're talking about how low can this go? What are the experts saying? Well, the experts, while they can look at, decades of experience and fundamental data, they are still only going to give us projections, right? And those things can help. That's what I hope to give you tonight, right? I want to give you an idea of where this thing can go, but more than where can it go, right? More important than that, what I want to get across to you, this is what I hope to do in every training, in every lesson we do here on Market Monday, is how can you think powerfully about your money, your trades, your perspective on the market, more so than leaning on certain information that other people might give you, because that information may turn out to be right. It may not. They are giving us projections. They don't know for sure. Now, I think there's something to be said when people have a lot of experience. I take it into consideration. I want to look at that. But again, the main thing for you, and this is really what we major on at Tradeway, this is what we do. I don't just want to tell you what to think, but how. How do we think? This is a little off the trail here, but I've told you guys that I have sat with many people now over the last, well, it's about a month and a half now, and they've shown me retirement accounts that are significantly down. Now, we expect some fluctuation in your long-term retirement. I'm not going to be, alarmist or overly dramatic for effect here. You're going to see fluctuations, right? That's not abnormal in and of itself. But to see a quarter or more of retirement earned, lost in that time, or as a trader to think, you know what, there's really nothing I can do in this market. I'm trying to force stock trades, and maybe I'm just taking stop outs, but I don't really know that there are other options for me in either scenario or both, right? It's important that we get empowered. And that's my whole point, right? We don't want to see that happen. We don't want to see that happen. So these are just projections. Okay. I mentioned on a previous broadcast, this is a little bit more of a doomsday projection, but I would say it in here for interest sake, expertise sake, but also because again, we don't know. One of the number one rules in trading psychology, I'm going to give this to you guys tonight. One of the number one rules is to remind yourself of this: anything can happen. It's when we start to think in our trading that what we're doing is a sure thing, or we become so biased to one direction or the other that we stop considering the risks of what we don't want to happen happening, right? Now, some of us are way too focused on what we don't want to happen. And maybe that means we've never learned to trade. Maybe that means we're starting to learn, but we're not very active. Maybe that means we're still trading, but we're paralyzed by fear because we think more about what we don't want to happen. That's the opposite extreme. Okay. We don't want that either. Fear is never good for trading. That's basically the second thing I would say about trading psychology. Fear never helps our trading, right? Wisdom does, fear does not. But the first thing to say is that anything can happen. Now, Michael Burry that I mentioned was the individual that shorted the housing market. Joshua mentioned 2008, the housing crash. He shorted the housing market, right? Made some, I don't know, I can't even remember the number. We're talking billions and billions. I think hundreds of billions, even perhaps slightly less than that. A lot of money. And he is projecting around 2,200, which is our COVID low, which as you can see my crosshair there, but right there around 2,200. It's not to say that he's going around saying it's going to be exactly 2,200, but that we could see that. Now, generally speaking, we deeply injured the economy due to COVID, right? It's the way that it went down. We're not here to necessarily debate what could have been done, but what we see is that enormous amount of stimulus. And we've talked about that on here repeatedly before, but just imagine if it did. Now, that wouldn't be something likely we're going to see in a short term, right? But over long term, could we get back to a level that we've been at? Which, by the way, if I go to my 3-year weekly chart, that's going to go ahead. It's going to zoom out and give us a little bit more of a perspective here. That's down here to the 2,200. I need to go. Let's do this. I'm going to go to a 5-year weekly. That's what I want. Okay. So we actually hit those COVID lows. It's a pretty significant low, right? We'd actually been down around there before, right? And going back into about 17, a little earlier on in 17, that's where we were. So this bull market, this has been grinding away for a while. And those COVID levels, while that was a huge decrease in a short amount of time, it's not that we haven't been around those levels before for a significant amount of time. It's just interesting to note when you go back here and you're basically getting into this is January 18 right here, right? So we're back into 17, 18, 19, 20. Just look at 21. Jeffrey, one of the other coaches here at Tradeway, and I were joking the other day on a live broadcast. When we used to see 30 points on the S&P, we used to say, "Oh, that's a big day. That's a big day on the S&P." That was probably around 2016, 2017, right? That's a big day. Right now, 30 points, that's nothing, right? The expected move every day is 40 points plus, at least, right? We're getting some big days. So times have changed, right? So could it get down to the 2,200? Maybe. Anything can happen. Is that a little bit extreme? I think probably, yeah, that's a pretty extreme projection. That's pretty grim, right? We would have to see a lot of negative components just continue to grind away to force that kind of negativity into the markets. But again, a lot of these evaluations are very, very inflated, meaning that the money has flown into the market. That doesn't necessarily mean those companies are doing even close to that well, thus holding that evaluation, right? When those two forces get really far and we start to see economic conditions change, they're going to have gravity. They're going to start to pull back together. And that's why we see this market coming down. Another one is the COVID highs. I should say pre-COVID highs, right? Right around 3250, 3275. Which would bring us pretty close, right? We're looking at this chart right now, this 200, right? This 200 moving average right in here. Okay, this is a 5-year chart. So we could come down into that. Now that would be more so if we're looking on this right now. This is a weekly chart, okay? Keep in mind, this is a weekly chart. We're coming up into that level, even just another move down, right? Even just another move down, which is still no small move. I mean, we're at 38.55 here on the chart, getting down to around, 3,500, right? That's still another 350 point drop. That would bring us into that level. I have to be honest, when I think about this whole bear market shaking out and ending with just another 300 point drop with what's going on, I'm not going to hold my breath for that, right? I'm not going to hold my breath for that. Here's the big thing though, guys. The chart's going to do what the chart's going to do. And we are going to be here to navigate that because we never know what a stock is going to do. We use our system to navigate that. You can see that we've got the S&P breaking the uptrend, getting into a downtrend. It starts to wedge, breaks out, forms another downtrend. Now it appears to be making a little bit of an M pattern on here, right? We haven't confirmed, but it's definitely in a bearish formation, in a bearish trend. Okay. So despite the projections, despite what the experts are saying, some of those key technical levels are something we can keep in mind, right? We could look at some others. I'd say those are some pretty big ones to say, where could we really see this thing bottom out, technically speaking, looking at the price on the chart. But we are still in that downtrend, okay? So number 2 tonight isn't just, what are the experts are saying? What are the experts saying about how low can it go? But number 2, well, what can we do? Well, let's just look at the tone overall, right? Let's just look at that tone and say, all right, treat it almost like gauges on the dashboard of the plane that we're flying. Okay. Are interest rates still going up? That's something to watch, right? The Federal Reserve, are they still going to raise interest rates? Are they still talking about it? Are they still saying they need to do it? Pretty much as long as they're doing that, we're going to see them grind away at the market, right? They are trying to shrink the economy. I've gone into this in length in previous broadcasts. They're trying to. That's what they're trying to do. Okay. Now they're trying to do it with a little bit of finesse, right? So as to not shrink it too much, but they're needing to be more aggressive because as they're kind of beating around the bush with it, it's not really helping in terms of inflation. So they're being more aggressive. Wall Street is responding and dropping the market, even on the days that are up. The overall tone remains pretty negative. Doesn't mean we don't have big up days. In fact, that's one of the things I wanted to highlight for you guys. You will see big up days, not just big up days. You'll see some pretty big runs. I mean, we had a couple of great days here, didn't we? It came down, we put in a higher low and had a couple more great days. Got above the moving averages. Whoops, I grabbed the wrong thing. Let's do it like this, right? And now, pulling back again, right? Still in the downtrend. Here's what I ask students. Are you closer to support or are you closer to resistance? It could come up and break resistance. It may yet do that. We don't know. But are we closer to resistance? Are we closer to support? We're closer to resistance. So we have to keep in mind the kind of risk we're taking, even if we're seeing green candlesticks, right? It just has to be in our field of vision, because as traders, that's our job, right? That is our job. So that's really important to look at as well, okay? Interest rates are going up. S&P is in a downtrend, and I think for me, this will remain. I think obviously I mentioned earnings is going to be a big deal, right? Just the overall tone of earnings season always impacts the market. But with all this recession talk in the air, let's see how these companies are doing. We should be getting a GDP report this month as well. That's going to be a big deal. So economic news as a whole, we don't need to know all these stories, but it's creating a tone. The big one, though, is inflation. Are we going to keep seeing inflation rise, right? That's what we need to know. And that's what the Fed wants to know. So if you're saying, well, how low can it go? Can it go any lower? Don't just look at whether or not stock prices are X% down from the high, right? The further it drops from the high, yes, that will draw in some buying interest. But where is the confidence going to come from to really create a longer term bounce? Well, that's something that's going to come into play as these conditions really change. We'll look at that more specifically next week, okay? Next week. So you will see some bounces, but remember, it's easy to get caught in the trap here, right? I'm not saying that there aren't going to be any people who take trades to the bullish side here, but if you're trading directionally, you just got to be aware you are trading counter trend, right? So that means things like position sizing, stop outs, things like that are going to help you protect your money, because you are going against the grain. Doesn't mean it can't work, but over time, probabilistically, you are working against the grain, right? You're going against the current because it's moving down, and that tone is very negative. So we need to see that negativity begin to shift. And even on the days when the market is moving up, right? Even this last week and several weeks back, as the market's been moving up, there's a real negative tone in the air. So it's what we call a divergence. Okay, when you see positive S&P chart, but negative tone, it can happen. It can happen anytime they want. But overall, the tone, if it's strong enough, it catches up. How do I know that for a fact? Because the S&P is in a downtrend. So overall, even though it's moving up, stocks never move in a straight line, right? Not for long. It's actually ultimately that tone is prevalent in the price because it is moving down, and we expect that to hold, right? And it holds until it doesn't. So you and I need to know, how low can it go? Well, I said, number one, we've got some projections, right? That gives us a little bit of an idea of where it could go over time. Okay. Number two, we need to recognize the overall tone, and it can go low as long as that tone remains. It continues to liquidate as long as that tone persists, right? So for us, that doesn't just give us a level to guess on, it gives us some conditions to pay attention to, right? And as we see those shift, we might start to see buying sentiment entering into the market in a more significant way, right? The trick here is that the lower it goes, when there is a little bit of confidence, right? A flicker, then you can see some pretty ferocious buying because stocks are considered to be cheap. The problem is if we do that too early, then the tone overall, those conditions I just listed, they still haven't really changed. You know, I would say in a bear market, for a lot of us, we've got to give ourselves permission to miss an early bounce, or what I would say rip higher, right? If you're always trying to pick the bottom, right? You might end up stopping out of a lot of trades. It's not necessary for you to feel like you got to go out and pick the bottom, right? If the market were to turn around and trend up and give us a nice new hot bull market, there'd be plenty of opportunity for you there, right? And you wouldn't have to grind yourself away in a bear market trading counter trend. Because remember, things can always go lower. And that's the environment that we are in. Remember, if you've got those options training, you can start to flip the script here a little bit, right? We can start to use options to work for us when we're doing things like credit spreads, where the time is the factor. Time is the factor, not so much the price and getting the direction right, okay? Also, if you are still trading directionally, you're starting to put yourself in a position where that negative tone, right, and that current is in your favor. There still has to be timing to it, but it's overall working in your favor, and you're eliminating some of that risk of trying to push against it, right, and catch one of those big bounces. That's one of those high risk, high return scenarios, right? I want to catch that really big bounce, but I'm in a negative environment, so I have to take on even more risk to try and get that profit. How many of those do you want to miss? How long before that's not really worth doing, right? Something really important to consider. Last thing here, I've said it a few times, it can always go lower. So we need to keep that bubble in mind that Josh mentioned. We need to keep that bubble in mind. I'm going to read something here so I say it verbatim. You know, a PE ratio is what we call the price to earnings ratio. And essentially what this is one of the ways that we can measure the value of a stock by saying, what's the price of the stock in comparison to the earnings of that company? Okay. The price of the stock to the earnings. Now, it's not abnormal for a stock to trade at multiple times more than what that company is presently earning. Why? Well, because traders are willing to speculate on that stock regardless of what they're earning, and investors are willing to invest in that stock based on what they think the company is going to do in the future, right? So it's not that they're always one-to-one or very close to. It can trade at multiple times its earnings. But even though that's true, when it's trading at many multiple times its earnings, it starts to have some gravity, right? If it's too far, then there has to be significant optimism. There has to be significant confidence that the growth of that company is going to continue at such a feverish clip that they would sustain those prices. And when the money was rolling and flowing because of all this stimulus we've seen, that's the kind of evaluations we saw, right? Now, even though as traders, we don't necessarily care that much about a PE ratio, the overall environment of the market, if you look at PE ratios, you started to see, wow, these are way extended, meaning that the earnings of this company is not even close to the price of the shares. I've mentioned many times in webinars past that last year at one point, it had Tesla trading at 111 times earnings, which the next closest competitor in the automobile sector, I believe, and I'm remembering faintly to a degree right now, so I'll say that up front, it was around 13 to 14 times, okay? So that's not even ballpark, not even the same sport close, okay? That's extremely high speculation, and speculation creates a lot of volatility. Ultimately, like Josh commented, it creates bubbles, right? It creates bubbles where the value we're paying for something is based on that optimism that is just flying around the markets, not necessarily based on what that company's going to do. If anything comes and takes that optimism out of the market, it can send prices down pretty significantly. This is something I want you to understand, because when we're saying how low can it go, right, then we need to understand, well, how inflated was it based on stimulus and emotions, right? So the PE ratio, I'm going to read this currently, right? Currently, this is as of, I think, 6 days ago. The PE ratio on the S&P 500, so collectively those 500 stocks in that index, right, stands at just under 20 times, okay? So as a whole, that average there, about 20 times earnings. So it's still pretty high, but we don't really have a basis of comparison. Is 20 normal? Is 20 low? Is it high? If you look at the Shiller PE ratio, okay, now what's the Shiller PE? Without getting too complicated, The Shiller PE ratio basically just gives us the same thing. It's a PE ratio, but it takes earnings over a 10-year period and it adjusts it for inflation. In other words, in one sense, it gives us a more accurate reading, right? It's an interesting number to look at because it gives us a more accurate number. So if we look at that, then it has the evaluations in the S&P, right? That PE at about 30 times. It's still not before the drop, but now it's still trading at about 30 times the earnings of those companies in the S&P. Again, though, is that high? Is that low? We're not really sure. Check this out. The next thing they said was, this is not cheap, right? 30 times. Both of those evaluations, 20 and then the 30 with that Shiller, which is the last name of the individual who began to use that ratio. This is not cheap. Both of these evaluations are above the long-term historic average. Now, it did not state explicitly what the time frame on that quote long-term historic average was. It just mentioned long-term historic average, which is in the range, and this is what's important for you and I, of 14 to 16 times, okay? 14 to 16 times. So what does all that mean? It means that the historic average of the S&P trading and its price to earnings ratio is around 15. It's around 15, okay? And this is showing 30, okay? 30 if we look at that inflation adjusted level. So potentially even looking at, we're still double the average of where we were after falling some 22, 23%. So that's pretty significant. I still think that even that right there gives us enough reason to say, you know what? We can go lower. And there's the old saying that says the market can be illogical longer than you and I can be solvent. Now, what that phrase is getting at, I believe that was a Jesse Livermore quote, the man who predicted the 1929 stock crash, right? The market can be illogical longer than you and I can be solvent, meaning it can do whatever it wants to do, even if you don't think it should be doing that. And it can do that longer than your money can last. So let's you and I both do ourselves a favor and not try to make the market do what we want it to do, okay? We've got to know that we're in negative conditions. We're in a bear market. It's not going to last forever. Yes, at some point it's going to turn around. Next week, we're going to look at what are the kinds of conditions I want to watch for to see when it is turning around, okay? Because there's some very specific things I think we can watch for. It's not a crystal ball. I think some of it is common sense. We just need to know what to look for, okay? That is going to be next week. So remember, there are predictions, but they're just opinions and predictions. I think some are more informed than others, so it's certainly something we can take into consideration, potentially down to those COVID lows. It's not impossible. I think that's a more aggressive evaluation, but it's not impossible from somebody who called the 2008 crash. I would just say one quick thing on that, though. You know, that 2008 crash had a really key event that moved us from fear to panic, fear to collapse, okay? I'm not trying to predict collapse here. I'm simply saying in terms of a market collapse, we don't really have something present that is creating that dramatic of conditions. We may not get that, right? We may not get that. So that is case for watching to see if we get another push, but certainly he did predict that in 2008 based on the data, right? Based on the data. So we could see a much deeper drop. Remember that that's possible. The tone is negative overall, so be careful swimming against the stream. You'll see some bounces. You might catch some opportunities, but overall, until we see fundamental changes here and changes in the pattern, we're moving against the stream. And then also, of course, remember, hey, things can always go lower, right? We're still inflated. That bubble is still present, so we've got to be patient on that. Okay, guys, I appreciate you being here tonight. This was, can we go any lower? Sure we can. Sure we can. If you're sitting on some cash and you're looking for a time to get in, I don't think that's a bad spot to be. I don't think patience right now is a bad spot to be in. There's plenty of reason to think we have not bottomed out. We have not seen those fundamental conditions. Come back next week, Market Monday, 6 p.m. We'll be right here, and we will look at what should I be watching for in a turnaround. All right, that's what we want to watch for. I appreciate you guys being on, as always, spending time with me. Share, like this video, send to somebody. If there's somebody out there who needs to see this, wants to see this, you want them to see this, go ahead, send that over. If this is helpful to you, I bet it's going to be helpful to them as well. I appreciate you guys. Make sure to like and subscribe so you know everything we're doing on here. We're doing videos all week long, so you won't miss anything. I appreciate you guys much, and have yourselves a great night.